Imagine someone wants to start an accounting firm, but they have no clue how to do accounting. You'd probably think that person isn't going to be very successful. And it's the same thing in trading. The first step to running a profitable portfolio is to really understand the product that we are trading and what causes it to change in value or in price. It blows my mind how many people are actually trading options without really understanding how they work. And it's not that I blame them though, because no one's really talking about it in the online chat communities. But that's why we're here, to help change that. So if you aren't familiar with concepts like implied volatility, option Greeks, and variance risk premium, pay close attention to this video because it is absolutely crucial to your trading success. The first thing we need to understand about options is that options are volatility products. What this means is that options aren't just about whether a stock goes up or down. What they are really for is trading how much a stock will go up or down. The size of how much a stock moves is what we call volatility. Volatility is important to understand because if we think about how options work, the price of the options we are trading is determined based on how much volatility the market thinks there will be between today and the option's expiry. The more volatility the market expects, the higher the price of the options. And this is what we call implied volatility. So how do we actually make money buying or selling options? Well, let's say we choose to buy an option today. The price we pay is based on the expected volatility in the future. So let's go ahead and draw this out. So we'll draw a graph. And on the x-axis, we're going to have time. And on the y-axis, we're going to have volatility. Now remember, the market, just like us, is looking ahead in time and saying, how much do we think a stock is going to move? The more the market thinks the stock will move, the more expensive the options will be. Let's say that this right here is the level of volatility the market is expecting for the future. And let's say right here is when the option expires. Now, as time moves forward, the stock starts to move. And let's say we start to see moves that are way more volatile, way bigger moves than what the market expects. Well, at any of these points in time where we're seeing more volatility or bigger moves than what the market's implying, our options would start to increase in value for a couple of reasons. Number one, the amount of movement we're seeing is higher than what the market implied. And there's also a chance that the market looks at what's happening here and says, wait a minute, maybe our forecast of what volatility should be in the future is too low. And they may start to raise the level of implied volatility that they expect over the same time period. If we see this level increase, or we're seeing the moves outsized compared to what's implied, that option we bought will increase in value. Now on the flip side, let's say we sold an option. What we would want to see is that as time moves forward, the realized volatility is actually lower than what the market implied. This spread between the two would be the money that we're making, the difference between the implied volatility and the realized volatility, the volatility that we actually see happening in the market. And we would profit in two ways, similar to if we were buying the option and we saw outsized moves. First, because we sold at this level of volatility, this is the price that we sold the option for. Now, if the stock's moving down here and volatility is a lot lower, well, we are only paying out on the option we sold at this level here. The gap between the two is the money we're making. At the same time as this is moving down, there's also the chance the market says, wait a minute, maybe our forecast of the future, the implied volatility we were quoting these options at is too high and we need to adjust it. So this level here might actually come down, maybe to here. And what this points us to is that there are two ways we profit from selling options. The first is the level of implied volatility comes down. And the second is that realized volatility is less than implied volatility. In these two circumstances, we would be making money by selling options. And for buying options, we actually want to see the opposite. Remember, in a trade, when you put on a trade, the person on the other side has the exact opposite risk exposures of you. So if you're selling and you want implied volatility to come down and realized volatility to be lower than implied, the person buying it wants the level of implied volatility to go up and realized volatility to be higher than what the market was originally implying. So this points us to another question, right? If we can take either side of this trade, is there a benefit to being on one side or the other? Does realized volatility usually overstate or understate implied volatility? Well, to answer that, let's take a look at a graph here. We're going to look at UNG. What we have here is the green line is implied volatility and the blue line is realized volatility. Looking at this chart, we can see that the majority of the time, the implied volatility is actually overstating the realized volatility, with small periods where the realized volatility actually shoots up and goes well beyond the implied volatility. Now, why would this make sense? Well, if you think about how an options payoff graph looks, the option seller is really the one holding the risk. When you buy an option, you pay a debit for it. Maybe you pay, let's say, $100 for the option. The most you can lose is your $100. But the person who sold you it, let's say the stock you bought a call option on goes up 100%, well, they're on the hook for way more than the $100 that they collected. So if it was even between the buyers and sellers in terms of how much money they should make or lose, who would want to be on the sell side? I know I wouldn't. And for this reason, there's actually an embedded premium, a benefit for being the option seller, to incentivize people to take the other side of that trade. And this premium is actually the core of how many professional option traders go about building their business in the market. In fact, it's such a prevalent phenomena that they've given a name to it called the variance risk premium. And that variance risk premium is going to be the basis on which we build out our option trading business. 3 strategies that we go over in the remainder of this course are all built on this variance risk premium concept. But what they try to do is not just say, okay, where's there some premium for us to collect? They try to help us find where is the most inflated premium for us to collect. See, when we're trading options, what we're trying to figure out is not just, hey, where can we make a little bit of money for providing a service, right? For providing this liquidity and selling these options. We want to find where we are getting paid the most for doing it, the most overcompensated, right? Imagine someone wants to insure a Honda Civic and they're willing to pay you $3,000 a month to do it. Well, that would be a very obvious thing to do, right? But to really know that that's an obvious thing to do, we need to be able to price that insurance and say, okay, well, let's take a look at who this driver is and what's the condition of the car and what's the road conditions. Does it make sense to do this? And if we can determine that, yes, this is a really inflated risk premium, that we're collecting way more in premium here than we would likely have to pay out in the future, we want to be taking those trades. And each strategy finds a unique way for us to go about doing that in the market. And you might be asking yourself now, but Sean, what if I sell a call option and there's not much volatility, but the stock slowly trends up past my break-even point? Won't I still lose money? Well, in this case, the answer would be yes. But that's because the call option is not just a volatility tool. An actual call option also has that directional exposure. You see, in the world of options trading, this is actually not the way we usually do things. We're not just buying and selling calls individually. What we're doing is we're actually using combinations of puts and calls to put on trades that give us direct exposure to volatility without needing to care about direction. When we put these together, these are what we call option structures. And there are many different kinds of option structures that each help us capitalize on different market inefficiencies. And this is actually what we're going to dive into in the next video. We're going to go over 2 of the most powerful option structures which you will be using to run the strategies discussed at the end of this course.